Hey guys, hope you and your families are well. I'm going to teach you things I've learned from studying deliberately 1,354 volatility contraction pattern breakouts. Now, I've studied many more. These are just the ones so far in my chart model database. Now, I have over 3,000 setups, breakouts in my chart model database, and you can access it for free in essence. I have a 7-day free trial of the membership. You do not need to enter a credit card. So if you would just like to go through, take a look at the 3,000 different breakout setups, VCPs, cup and handles, flags, Davis boxes, all of that good stuff, you can for free. All you need to do is enter your email address using the link down below. So what I'm going to do, as the title of this video suggests, I'm going to take you through some VCPs and I'm going to teach you a couple of things that I have learned. So simply come to the chart model database, hit VCP. You could select other things as well if you want, coming handles, flags, pocket pivots, whatever you want to do. We're just going to look at the 5-star ones, and we're going to look at the oldest ones first. So let's just go way back when in time. So you can see we start back here 1927, 1972, so 1970s, 1980s, 1990s, so on and so forth, right? So let's just hit charts. Now I'm just going to go through some, and I'd really encourage you, go and access this, study them. You can save them, you can print them off, whatever you want to do basically. So what have I learned from trading the VCP, studying them deliberately as well? So many VCPs will have, the average for me is between 3 and 4 contractions. That is irrelevant whether you are, or it's not irrelevant. It is the same whether you're on the 1-hour chart, the daily chart, the weekly chart, whatever time frame. The most common in terms of the contractions that I see are 3 to 4. Now, ideally, you'd like those contractions to be building higher lows. So if we take a look at the Dow Jones here on the weekly chart, you can see you've got 1 contraction, bounce, higher low, 2 contraction, bounce, higher low, 3 contraction, bounce, higher low, 4th contraction there, and volatility should be contracting. Now, what I found as well is across all of the different time frames, the best VCPs, invariably the pivot, which is where you start getting the real tightness in price. Ideally, it's in single digit in terms of the percentages on the weekly chart and the daily chart, forms above all key moving averages. So just an observation of mine is actually the strongest of the strong ones. The pivot, when price starts getting really tight, will set up above all of the key moving averages. So you're looking for higher low contractions. And are they all going to kind of blast out and go up 1,000%? Absolutely not. That's why the risk management, the risk mitigation, the free rolling part of trading, I think, is extremely important. But here you go. You can see how it starts building the high low contractions. There's 4 contractions. This is FMC. This is January 1976. You have 1 contraction, bounce, 2 contraction, high low, bounce, 3 contraction, high low, bounce, and then you get tightness. But note that kind of pivot and the trigger bars, we'll talk about trigger bars in a couple of minutes time, is happening above all of the key moving averages. So you might get the contractions are kind of ebbing and flowing around, but ideally you want to see the actual pivot setting up above all key moving averages, especially for me as I'm then trying to ride that intermediate term trend. So it's easier when it's setting up above all key moving averages. OLN, January 1976 again. So you see how you get 1 contraction, bounce, 2 contraction, bounce, 3rd contraction, bounce. There's a bit of VCP, flag, and the volume drying up in the pivot as well. So let's start talking a little bit more about volume and characteristics of the candlesticks as well. So ideally, you see in the pivot here, see how you're going through the contractions, and then look how the volume from left to right dries up. So you should be able to basically stick an arrow on the chart, and the volume should be coming down around about a 45-degree angle of descent or so. You may have a couple of volume bars sporadically kind of popping up in there, but generally speaking, left to right, you're looking for the higher lows, you're looking for the depth of those contractions to be lessening, and you're also looking for the volume to be coming down. So higher lows, volume coming down, specifically spending long periods of time below the 30 bar average, which is this black line. I use 30 bar whether I'm on the weekly chart, the daily chart, the 1-hour chart, whatever time frame. Just keep it the same across all of those time frames. You want to see that volume coming down in the second half of the base as well. Preferably you see a large dry up in volume. So you might have a kind of couple volume bars popping up like this and green volume bars, but you can see, generally speaking, if we were to split this in half, okay, I would say 90% of the volume bars in the second half of the base are below the 30 bar average. There's just another thing to be looking at in terms of the volume. Now let me find one that's a good illustration of trigger bars. Okay, this is quintessential trigger bars. Now this stock here is very thin, but a relatively extreme example to illustrate a point. So we've got SGC, and we're back in July 1980. Now this is no supply coming to market. So you see here, see how this pivot is building. So you have these contractions, and then you actually have a little Davis box in kind of mini VCP forming over here. But see how price is not going anywhere for about 5 days in a row. And look at the volume, consistently below the 30-bar average, and certainly in the last 3 days. Now the last day there, you see this bar here, price isn't going anywhere, and look at the volume. There's no volume, there's no price movement. This is telling you there's no more supply that's coming to market. So that analogy of wringing out a wet towel, there's no more water coming out of this towel. There is no more supply that is coming to the market. So something to look for. Looking for the contractions in price. 3 to 4 is probably going to be the norm in terms of the contractions you're going to see within a base. You can get more than that. You can get less than that. If you get to kind of 2, that's more of a cup and handle in my view, or potentially a flag. Kind of depends how it's playing out, or maybe a Davis box. But 3 to 4 is the norm. Volume, generally speaking, so you see here, it's not perfect, but the volume, generally speaking, is falling here from left to right. You see that. Then in the pivot, you're looking for extreme tightness in price. So what I call trigger bars. Trigger bars are basically, they're pretty much inside bars or very close to inside bars, but the real body on the candlestick is really tight. The overall range is really tight, and preferably they are sat on one or more key moving averages. So the 10 EMA at a minimum is what I like to see there on the daily chart. When you then drill it down onto the 1 hour chart, commonly that there coincides with the 10, 21 and 50 SMA on the 1 hour chart as well. Just a nicer reference point to kind of better ensure that I'm not buying extended. And then the extreme volume dry up as well. Generally speaking, the trigger bar, you can see the lowest volume thus far within the base, but it's the context of where you're seeing it happening. So this here, extreme example, but that there is no supply that's coming to market. Then I'm trying to ride the 21 EMA for at least part of the position. So I wouldn't trading in 1980, but that would have been a good move. Let's see what else we got. Let's keep going through it, and again, I'd encourage you guys to scroll through these ones. We got ones on the weekly chart as well. So do you see how over here this is actually versus the index? So you see a couple of these as well. This is a good one to do. So we've got PHM on the top here, weekly chart, July 1982, and then below that we've got the Nasdaq Composite. So these dates are lined up, and this is then to illustrate the point of relative strength as well. So do you see how the stock actually makes its low here, okay, in September 1981, and then it starts building higher lows. So the VCP nature of it, right? 1 contraction, 2 contraction, 3 contraction. Appreciate a little bit harder to see, but then do you see how you get these trigger bars, the extreme volume dry up as well? 52-week highs on the relative strength line. So this stock here, this is PHM, is building higher lows. The RS line is turning up, and look at where the index is. The index is making a lower low here, whereas the stock is breaking out. This is the same in 2023 as 1982. Nothing has changed. Relative strength is relative strength. Now from this trigger bar here, from this first trigger bar where it tightened up, and from the second one here, the stock goes up 815%, and this black line here is the 10-week. See how the 10-week encapsulates this whole move, whereas the index has gone up 80%. Makes sense? But the stock was breaking out while the index was making a lower low. Interesting, right? That's the relative strength point. Focus on the leaders. This one here, this is BBWI. So you see here how you get 3 contractions in the base. You get 1 higher low, 2 higher low, 3, and then you get another little pivot setting up here as well. See how the volume dries up. Look at the 52-week highs. That's a free tool. Search my name on TradingView, you'll find it. I like to see those blue dots coming through. This is EBF. This is September 1983. So let's just look at the volume first. See what I mean? Generally speaking, the volume, you could draw an arrow here and see how the volume is falling, and then if we were to split this base down the middle, do you see how about 90% of the volume bars in the second half of the base are below the 30-bar average, and you have the higher lows. You have price consolidating around the key moving averages. Look at the 52-week highs on the RS line. You get a 52-week high while the stock is still in the base. The stock's telling you it is so strong. Now this one here, this is CRS, a little bit of a cup and handle, a VCP as well. So the volatility contraction is a characteristic you're going to see in other chart patterns, flags, VCPs, obviously, cup and handles, Davis boxes, so on and so forth, right? So here you can see how it starts building this contraction onto the 10 EMA. This is this black line here. Look how the volume dries up. So something to train your eyes for is extreme tightness in price, extreme volume dry-ups. Look at the 52-week highs coming through on this stock while it's still in the base. So this is saying the market, the index, is pulling down, but this stock is just going sideways to up. It's extremely strong, and then it powers out of the base there. Let's maybe finish with let's finish with this one here. But I would encourage you, I'm literally giving this away to you guys for free. You just need an email address and you can go and access it. You don't need to enter a credit card. You can literally go through over 3,000 stocks in a chart model database that took thousands of hours to kind of complete. for free if you want to. The link is there. I don't care if you do it or you don't, but if you find it helpful and it helps you improve your trading, fantastic. That's why I'm doing it. So MCD, this is McDonald's weekly chart, 1984. So we've got McDonald's on the top, and then we've got lined up on the weekly chart the Nasdaq Composite below. So look at McDonald's here. This was kind of more so in its growth phase, but look at this here. Back in the summer of 1984, there's a song around that, or is it summer of '69 for some of you older folks? So see how McDonald's here, it's got one contraction, bounce, higher low, another contraction, another contraction, another contraction here. Look at the 52-week highs coming through on the weekly chart before it starts breaking out, and then look here, contrast that to the index. The index is making lower low, lower high, lower low, lower high, lower low, lower high. McDonald's is screaming at you. It is incredibly strong. So that there is the relative strength point, and you'll find some charts like this within the database where I'm comparing the stock's action to the applicable index as well. And I'd encourage you to do that for yourself. Understand the relative strength point, that if the index is going down and making lower lows, and the stock is putting in higher lows and building a constructive base, and even better if it's hitting 52-week highs on the RSI, and it's telling you it's extremely strong. So that's it, guys. I will wrap it up there. Thank you very much for watching the video. Remember, that link is in the comment section below. I'd encourage you to use it. You can go and look at the VCPs, the flags, the Darvis boxes, the cup and handles, whatever you want to look at. You'll see lots and lots of examples there. So thank you very much for watching. Appreciate the support on the channel, and I'll see you in a future video.